Comments that I'm about to make are of my own opinion, not that of Cambridge or any other affiliation or relationship that we have. And, the slides are a combination of things that I've created and things that I've found from the various resources that we have, and put those together to really communicate to you some of our thinking, and also for, of course, education purposes. And today is a topic, as you probably know from your emails and from the cover slide that should be on your screen, is titled Manias, Bubbles, and Panic. Oh no, what do we do? And I'm going to dive in, but our last commentary, just as a reminder, we focused primarily on the new tax code, and that was, of course, signed on July 4th of 2025. And we did have great attendance for that, but the number of views of the recording was at an all-time high. So we're really seeing a lot of people watch these videos after we post them up to the website. Just a reminder, that does typically take us 2 or 3 weeks to get approved from compliance, because we have to also edit it for things that they don't want us to include. And then we post it up to the website for your viewing whenever you would like to. This was the first time that I recall a quarterly commentary being so heavily discussed in our meetings that followed. And the interests were pretty widespread, but the most common were trying to understand the so-called tax-free Social Security, as well as the opportunity to deduct interest on an automobile loan, and also the restoring of most of the 100% business deductions that were for many different expenses, but especially bonus depreciation. As we concluded the tax bill review, I also touched briefly on the markets and some of the concerns that I have with regards to the current market conditions. And that's kind of the segue to this presentation, because those concerns have not changed. In fact, they've probably grown a little bit. And hence the title that I chose, which was Manias, Bubbles, and Panic. Oh no, what do we do? And the first step is to get our arms around what makes a bubble. And I take you now to the 5 things that are most common in a bubbling environment. First and foremost, one of the most common aspects of a bubble is that there's a storyline of some kind that drives the market, whether it be the infamous tulip mania that took place back in Dutchland in the 17th century, the South Sea Company bubble of 1720, the stock market of the roaring 1920s, the Japanese market bubble that occurred in the 1980s, the dot-com bubble that so many of us are familiar with in the 90s, or the housing bubble of the 2000s. There's really pretty much always been a big storyline that heavily influenced a bubble. While we're not clear on what today will bring, it is quite likely that the Mag 7, the Magnificent Seven, and artificial intelligence will be the storyline of this potential bubble. This phase of the bubble is often referred to as displacement, which occurs when investors are enamored by a paradigm shift, such as historically low interest rates, new technology, or both, which are obviously recent history in the US. Alan Greenspan coined the phrase irrational exuberance in December of 1996 in describing the enthusiasm of investors in relation to the dot-com bubble of the 1990s. That's important to note, because the bubble lasted more than 3 years after that famous comment, suggesting that it is nearly impossible to determine the end of a bubble. Therein lies the challenge for investors, and even more so for people they rely on to best provide guidance. This phase can often be referred to as the boom phase, where prices rise slowly at first, but strengthen as people pile into similar investments, igniting a run-up in specific asset classes or stocks. I had the team assemble some of the headlines from the last few months from various sources, just to show you how rampant the current stock market concerns actually are. Again, this does not mean that a correction or crash is imminent, nor is it intended to suggest that the timing of such an occurrence is obvious. This simply reflects the most common feelings among professionals in the financial services industry. This chart, which is from ampex.com, reflects the price change over the last 5 years of the S&P 500, which is in blue, as well as for gold, which, well, it's in gold. I'm not sure how many of you would have expected the result that we see here, as gold has far outpaced the performance of the S&P 500 in recent months, while it tracked pretty closely to the S&P 500 for the last 5 years or so, up until really the beginning of this year. Now, I could have included Bitcoin on this chart, but its performance would have dwarfed the charts of gold and the S&P 500. And the point that I wanted to make here would have been not very clear. Knowing that many of you would still want to see that chart, I did decide to include it in this slide so you could see the strength of Bitcoin over this time period. You can see how muted the charts of the S&P 500 and gold become as Bitcoin has outperformed gold over that same time period by about tenfold. The green line represents Bitcoin, and then you can see how muted both the S&P 500 and gold are as a result of Bitcoin. Now, I've only reflected on 3 asset classes here: Bitcoin, the S&P 500, and gold. But others have certainly followed suit, one of which is seeing a downturn in many parts of the US, that being real estate and the housing market in particular. This phase is often referred to as euphoria, as many set aside their cautious investment behavior and accept uncharacteristic risks to capitalize on the investments that others have. The greater fool theory comes to mind. And if you're not familiar with this, it simply means that no matter how much it costs, there will always be a buyer willing to pay more for the position that you just bought it for. And the result is that you just can't lose. Of course, until you do. Now, I was a very young and inexperienced advisor in the late 1990s when the dot-com bubble was full swing. But I'm thankful that prior to that, I had read books such as Benjamin Graham's The Intelligent Investor, as well as many others, giving me an early bias towards value and an understanding of what really is meant as an investor. Those readings, coupled with the psychology courses I took at Hobart and William Smith Colleges, gave me a strong understanding of what drives FOMO, or fear of missing out, which is the popular acronym that we experience today that I think was yesterday's irrational exuberance. But also the suffering that also follows when it comes to investing specifically. As an advisor to you and to others, there are many challenges that we face in trying to do an incredible job consistently. Many of the decisions we influence or make on your behalf are at the risk of your immediate satisfaction, but they are key in your long-term success. FOMO, or fear of missing out, has a grip on every single one of us. Yours truly is no exception. Recognizing this is very empowering, and it helps us to better assess whether it's truly worth missing an opportunity, even though others are chasing after it. If others are chasing after it, as Warren Buffett has often said, it simply means that it's too late, or that the real opportunity has already passed us by. Finding those opportunities early is the real key to financial success, but often takes more luck than skill. Skill, on the other hand, is less about picking the right positions and more about assessing overall circumstances and how those have historically influenced the performance of specific asset classes. Interesting enough, this phase is referred to as the profit-taking phase, as many experienced investors begin to sell off the overvalued positions, acquire more appropriately priced positions, build cash from new monies received, and wait for the markets to tumble so they can deploy that new cash at a discount. Retail investors are left holding the bag as they continue to invest based on emotions as opposed to with discipline. Last, but certainly not least, is the valuation of stocks reaching a historically high level. The chart itself is not so much a concern, but the multiple that the stocks trade at are. If we start on the left side of the chart and note the date of March 4th, 2000 right here, we see that valuations were a whopping 25.2 times earnings. And what followed was clearly a pretty significant downturn, about 49%. And that lasted until about 2003, so nearly 3 years. Valuations in October of 2007 were only 15.1 times, but one could easily argue that this occurrence was influenced or caused as a result of the great financial crisis. And here you can see a decline of 57%. So valuations themselves are never, not always the reason for the decline. Moving along the chart, we'd see all the way out in January of 2022, where valuations climbed again to 21.4 times, and the markets experienced a decline over the next several months, quickly bottoming out as investors poured money back into the markets again. As of October 20th, valuations now sit at 22.5 times earnings, well above the 30-year average of 17.1 times earnings. Okay, here's your 22.5, excuse me. And the 30-year average, again, is 17.1 times. So that's about 32% above the 30-year average. Simply put, U.S. large cap stocks are anything but cheap in today's market. While valuations themselves are not a phase like the other four indicators of a bubble, what often follows high valuations is a phase referred to as panic, where sellers substantially outnumber buyers and downward price pressure causes the markets to fall, sometimes dramatically. So panic and euphoria. Just note at the bottom, the blue line represents euphoria and the orange line represents panic. Bubbles are not always clear, and they are impossible to predict as to when one might start and when one might end. Market cycles can often be confused with a bubble, but there's a very important distinction. Market cycles are supported by fundamental economic factors, while a bubble is fueled by unsustainable price increases that are not supported by fundamentals. Market cycles and bubbles are both healthy for long-term disciplined investors. The disciplined investor rotates their allocation periodically to reduce exposure to areas of concern and increase their exposure to areas of opportunity, each often contrary to what the mainstream investor might be doing. This chart reflects the last 5 years and the indication as to whether most investors are euphoric or panic-stricken when it comes to their portfolio. And if we pause and think about this, when panic last peaked in 2022, we see that here. When panic last peaked in 2022, the markets were down considerably, falling about 25% from January to October, with October ironically appearing to be the peak of panic in the chart that we see. I would call this roughly October based on the chart's time frame at the bottom, timeline at the bottom. And again, you could see that panic peaked at the biggest point, basically at the bottom of the markets. The reason I suggested you pause to think about this is that if the market is down considerably, that should mean that there are a lot of things on sale. And we should see this as a buying opportunity and therefore be euphoric. Investing has always been counterintuitive in this sense, with the majority of investors running from the market when it's down and running to the market when it's high. Many of you have seen this slide. If you've been following closely, you're likely getting the idea that typical investor behavior is detrimental to the long-term success of a portfolio. There is proof that at every turn, including this 20-year analysis done by J.P. Morgan. Similar studies are done by many firms, including Fidelity, Citi, National, Rockdale, etc. And the results are always about the same. The average investor tends to not only underperform, but do so substantially. In this study, we can see that the average investor performed worse than nearly every single asset class, with commodities and cash the only two that performed worse. This is the result of emotional versus disciplined investing. The chart on the previous page, reflecting panic and euphoria, is the disconnect as to under what market conditions investors are presenting those emotions. And that helps us to understand these dismal results. Now, a slide that I know all of you have seen, because I've presented this numerous times, and I came across this chart as a very young advisor back in 1999, and I've truly referenced this slide pretty much every week ever since then. I've yet to find a better representation of the market cycle and the emotions that coincide or are tied to those different phases of the cycle. These emotions are not of just the average investor. They're the emotions of every investor and advisor, including yours truly. The difference is that the average investor just doesn't know any better, while the disciplined investor recognizes the disconnect and acts opportunistically. Keeping in mind here, where we have the most difficult, most challenging feelings, that's the opportunity, that's the point of greatest opportunity. And here, where we're feeling the best, is actually not at all a great opportunity. That's the time where we should start to take profits and roll them to other parts of the market that have not been doing well. Now, capital market assumptions are a really important part of our work. Capital market assumptions are also known as CMAs, and they are a valuable tool as long as they are not used alone. CMAs are the projections that many major firms make with regards to the performance of various asset classes over the next decade. These come out every year, and the ones that we see here are from BlackRock for no other reason than the way that they present the information, and it's much easier to digest. This is only reflecting the various equity asset classes. And while I realize it may be hard for you to see, I felt that it was valuable to share. Let me explain this. The bottom axis here represents volatility or risk, and the left axis represents return expectations over that 10-year period. So no matter where we end up on this chart, if we end up where my mouse is, that's the 25% level risk or volatility measured by standard deviation. And if we track that across at that risk level for that particular position, we can expect a 6% return. So now if we just pick out a couple of asset classes, I'm going to first place my mouse on US equities, US stocks right here, represented by this level of risk, and the expected return over the next decade, again, this is BlackRock's, is roughly 5% and change. All right, so it reflects, if we then move to non-US equities, ex-US equities, we take a look, it's reduced risk, lower risk, all right, on standard deviation, and much better return result expectations over the next decade. Very interesting. And this is a common theme that we are consistently seeing in the CMAs that we follow from 2025. So point being made, expectations are not high for the next decade in US stocks. And really what we've experienced in the last really about 15 years has been the best bull market in history for US stocks. And typically when you experience that, it is a front running of future returns, meaning reversion to mean, we have to experience a softness in results in order for us to maintain the mean long term. Many of you have also seen this slide. So while we do see concerns for US equities, in particular large cap, as I've mentioned, we typically never fully leave an asset class. This chart does a good job of explaining why. If we start with the year 2024, which is represented right here on the right-hand side, looking at the very top of the chart, we see in green large cap, and large cap was up 25% last year. Whatever color or asset class is stacked at the top was the best performing asset class for that year. And again, I'm going to continue to focus on 2024. If we then look at the very bottom for 2024, it's blue, and that represents fixed income. That was the worst performing asset class for the year, up only 1.3%. So each year is nicely stacked with the worst performing asset class at the bottom and the best at the top. And what is evident is that there is very little consistency in what the best or worst asset class is each year. As a result, it would be risky to completely leave an asset class unless there was a tremendously compelling reason to do so. Next, taxes also must be accounted for in the event that a portfolio is a non-retirement account, and most of you have substantial non-retirement account assets. If you've held the position for at least a year, then you're faced with long-term capital gains rates. That rate depends on your filing status and your income and ranges. So that tax could range from 0% to 20%, plus the state taxes that might be applicable. In addition, for single filers over 200,000 of total income and married filers over 250,000, you'll also be impacted by the net investment income tax, or NIIT, which is often referred to as the Obama tax and implemented in 2012. If you're exposed to short-term gains, you owned it for less than 12 months, and you fall into the NIIT, your total tax would be as high as 37% plus 3.8% plus state taxes. So mathematically, short-term gains could be taxed at more than the highest income bracket because of the NIIT. If we take a 22% filer and add in 7% for tax, state tax, we calculate that an investment made of $50,000 that grew over time to $100,000 would incur a tax of 15% capital gains and 7% state, or a total of about $11,000. In general, and to keep this fairly simple, the way we look at this is that for a client that meets that tax criteria, we should expect about an 11% loss on the investment versus an alternative investment option to justify selling the position and incurring that cost. The magic word is expect, and realistically, we have no idea, but if it appears a high probability, then we would likely seek action. I wish investment decisions were easy to make. The truth is that there are many different things involved in making an investment decision, especially when it is on behalf of and impacts the wealth of a person and family for whom you care deeply. Many feel that picking the right investments is the most difficult. While that is difficult and time-consuming, the truly most difficult thing with investing is determine when to sell for reallocation or cash need purposes. Perfection would mean selling at the very peak and buying at the very bottom. We aren't fortunate enough to have a magic 8-ball to tell us when those times are. So we take into account many different things, including your overall personal situation, your tax return, and many other things to determine what is best based on our experience. Excuse me. And I really thought that this was a good slide because it references the many things that are involved in decision-making around investments. You need to have money to start with, patience, discipline, knowledge, long-term perspective, being prepared for losses and recognizing that losses will occur, and taking risks. While we do see opportunities to reduce exposure to U.S. equities and increase exposure to both bonds and international equities, we will not make a blanket decision for all clients, knowing that the impact is different based on the areas discussed today, as well as others. We will pursue changes when justified by an overall review and take into account the value creep or organic growth that has led to the outsized allocations to asset classes. We'll also take into account taxes, your overall personal situation, and the type of account owned. Roth IRAs, for the most part, will continue to be quite aggressive since those gains are tax-free. For some with large taxable gains in their non-retirement accounts, many of the changes will be accounted for in the traditional IRA or 401k. And for those with little or no option but to allocate in the non-retirement account, we'll have to determine if the tax hit is worth the change. Your team at Custom Wealth Management, as always, will be working diligently throughout this fourth quarter to not only address allocation concerns, but also overall tax planning, Roth conversions, and other year-end matters such as gifting and estate planning. This quarter is by far the most challenging for us. Add in the holidays, and it becomes a complete blur by the time January arrives. We do look forward to getting to the other side of 25 and welcoming in an exciting 26. And thank you, as always, for joining us.